We're in the right order. That was the instruction we had, was to sit in the right seats. So we've done well. Whoops. Yeah, we've done well so far. Ness, thank you for the introduction. And I have to say, on behalf of GEFI, I'm delighted to see so many of you here. And we've had some really, really interesting discussions. This session is entitled Regulatory Perspectives, Green Finance Centers. And when I saw that, the first thought I had was, oh my goodness, that's like chalk and cheese. You know, you've got, you think about the constraints and the stability that should come from good regulation, which is often based on past and recent experience, and the freewheeling, intense, urgent nature of developing and providing green finance. That's a new playing field. How do we reconcile those two mindsets? So that's what I hope we can explore in this session with our three panelists, who I actually see, they'll be a bit horrified at this, as examples themselves of chalk and cheese. So I shall introduce them briefly, really briefly, by an epithet basically, but do read their biographies because the three of them have had really, and still have, really interesting careers and experiences. So I'll start at the far end with Ian Johnston, who I would simply sum up as poacher turned gamekeeper and influencer. And he's here as the chief executive of the DFSA, the Dubai Financial Services Authority, within the DIFC, which is Dubai's offshore free zone, of course it's onshore, for financial services, and also the physical host of COP28. Not Ian, the DIFC. And then we have Azalina Adham, who I would describe as a serial digital innovator and a serious networker. But she's here today as someone appointed early this year as the managing director of Malaysia's Securities Commission. And on my immediate right, we have, don't be horrified, rocket scientist, literally as well as figuratively, soon to be London's next Lord Mayor, but here today as the founder of ZN, which is the City of London's prominent think tank, which promotes societal advance through better finance and technology. So I'll start with just a short question, different questions to each of our panelists, because it's good on a panel to hear your own voice at the beginning, and then we'll see where all of that takes us. Michael, let me start with you. Your organization runs several global indices. There's a Global Financial Centers Index, and there's a little more recently, Global Green Finance Index. Do you want to tell us a little bit about these and sort of any trends that you're seeing recently?
Right. Well, thank you very much, Susan. And it's really a delight to be at GEFI. I've been here virtually in the past, but to bring the tartan tie home, although I now think I need to go out and buy an armchair. Anyway. Yes, we began the Global Green Finance Index some 8 years ago, and we did it in association with MAVA, who's, as many of you will know, behind WWF and recently wound itself up to try and spend its money to fight the cause. We have come out with 11 of these indices, so it's been quite an exciting series, and the Global Green Finance Index 12 will be coming out next month. We covered initially 47 centers, and today we cover about 86 centers. So you can see just from that the rise in people's interest in declaring themselves to be a green finance center. On the other hand, we do cover in the Global Financial Centers Index 126 leading centers, so there's still a gap of 40 centers not doing it. In the early days, it was very much a Western European affectation. There was really very little interest out, and in fact, the leading centers were Nordic. Since then, London has risen to be the top, but still 6 out of the top 10 centers are European. However, I would point out that overall the index has risen from 350 points on a 1,000-point scale to closer to 550, and we've been seeing some real progress, particularly in Asia. For those of you on the home team, Edinburgh ranks 14th in between Sydney and Seoul. And in the Asian sense, what I would point out is that what we find exciting has been particularly Singapore lying there just at 11th place, and I expect them to move up. China, of course, is on everybody's mind. The first Chinese center in the index is Shanghai, coming in at number 20. And there's been real performance improvement since China issued its emissions trading scheme in July 21. In terms of products and trends, well, it all started off with green bonds in many ways, but these use of proceeds bonds and greenwashing really started falling off about 4 or 5 years ago. We then saw a lot of interest in in corporate sustainability-linked bonds, energy efficiency and infrastructure, and lately a renewed interest in the carbon markets, I think due to China and the fact that carbon markets now cover 23% of global emissions, which is often overlooked. However, regulation is a constant thing there, and I know that we'll be talking about that. In closing, I would just simply say, if you'd like to help the index at a personal level, go to it and fill in the questionnaire. You're all qualified, and you've all got a global view. And secondly, if you really want to help us, Abu Dhabi, who has been our sponsor, has indicated that they're going to move off of sponsorship, so we're looking for a major financial institution or center who might like to sponsor. So that's the sales plea.
I didn't know we would get that. Thank you, Michael. Thank you very much. So Azalina, Securities Commission Malaysia is a self-funded statutory body responsible for regulating and developing Malaysia's capital market. Can you say something about how that mission has evolved over time, but particularly referencing sustainability?
Okay. Good afternoon, everyone, and it's great to be here. It's my first time at GEFI and my first time at Edinburgh. So unfortunately, I think I'll just get to see the castle this evening, and that's about all I remember for now. I think, yes, Malaysia, the Securities Commission has an interesting mandate. We have both the regulatory as well as the mandate to develop the capital market. Many regulators don't have that. Predominantly, most of the regulators have the mandate to regulate the markets. So how it has evolved for Malaysia, in particular in the area of sustainability, is we had a slight advantage of having the Islamic finance and Islamic capital market from the early onset. It's 30 years old for us. It was done on a voluntary basis, creating an ecosystem without it being forced or putting it out as a requirement, as opposed to it being a choice. And we find that to be very, very useful and very powerful, because today, 30 years on, 2/3 of the stocks that we have on the exchange is Sharia compliant. In terms of fundraising, 2/3 of the bonds that are issued are sukuk. So we are happy to see that, actually. So premise on that, how we have approached sustainability in Malaysia is very much taking a role of a developmental role and stewardship. And that is similar across ASEAN, actually, if you look at that. Malaysia is very active in the ASEAN fora. We are part of the ASEAN Capital Market Forum. A few things that we look at when we look at sustainability from a development perspective. Number one is that we approach it from a framework and guideline perspective, so that it assists companies with reporting and, to some degree, the disclosures that it needs. Encouraging disclosures, giving a more phased approach. So companies are given time to actually look at the types of disclosures and what kind and when can they do this. So they have a little bit of clarity on the path. Second, which is quite critical for us, especially in developing nations, is also to make sure that there's continued access to financing. For that, actually, we also, again, provide frameworks so that there is clarity for both financiers and investors to look at this. We've actually issued many, many standards, green bond standards, sustainability-linked standards, so that financiers and investors can have some frame to see how do they want to take on the financing or not. The third thing we've also done along the access to financing, the second, is actually way back in 2014, the ASEAN as well as Malaysia had already worked with FTSE to set up an ESG index way back, FTSE for Good. So we've always been part of that. And with that commencing the disclosure requirements around sustainability, but in a very light touch kind of way, getting companies to desire to be in this premium standard as opposed to coming at it from a regulatory requirement. The third thing that we did around finance was we started in 2017 very actively looking at developing private markets, which is alternative. So to all the bankers here, with all due respect and all the standards, sometimes it's a little bit slow to get the financing access for the companies. And we found that private markets have done really well. That's the equity crowdfunding alternatives, the P2P, and even junior markets in some of our marketplaces. So we found that to actually provide some better access. What we've also now spent time on, apart from financing access, is actually, this is actually the tough one, which is capacity building, which is getting people familiar across not just the preparers, the companies, but also the assurers, the auditors, the regulators, to understand what this is about. So I'll share a little bit later some of the things that we're trying to do in ASEAN. So I think that is number one, the stewardship and the developmental approach. But just very quickly, I also wanted to share an insight that what we're finding as a regulator in this region is that there is a broader reach that we will have to go to, which is to the SME markets, to the supply chain, because we're finding that companies are affected, even though they may not have the requirement or the need to follow ISSB standards, they are getting to have to meet these ESG standards or some kind of measure. So there is a lot of effort that we do. For example, at the end of this year, we will do a simplified guide for SMEs to look at how to fulfill the ESG requirements to be able to at least satisfy their client base. If they are serving a multinational, although it's not required of them directly, but they will have to have some understanding of this. So far, I think that's the kind of evolution, more stewardship rather than a more regulatory. And I think what we noticed is that it really needs a mindset shift at the regulatory level, but also at the corporations, that the corporates, as in the board and the chairman and the CEO, really need to want to do this. Otherwise, you're just going to be chasing around trying to, it'll be a catch up with each other. So that's kind of where we're at.
Azalina, thank you very much indeed. I think really interesting to me, certainly, and to the audience, sorry. Ian, sort of mindset differences. So can you say something about what the opportunities are and maybe the challenges of being a regulator in a special economic zone and not simply a country, and so a different playpen?
Sure. So I should probably start by explaining a little about what the DIFC is, the Dubai International Financial Centre, because not everyone would be aware of that, and then some of the opportunities and challenges that presents. So the DIFC is it's a physical and legal jurisdiction in Dubai, 110 acres. The idea of the DIFC came from the Dubai leadership about 20 years ago, a bit more than 20 years ago, whereby they saw the vibrant and credible financial centres of the West and the vibrant and credible financial centres of the East, and realised that there was not much in between, even though there was a lot of wealth in that part of the world. Opportunities for capital transformation, and when you looked at the geography and the time zones, it made a lot of sense to have an international financial centre sitting in the Middle East. They realized, though, that that was probably not going to be easy to do unless you could build a legal system that the world's financial institutions were familiar with and comfortable with, and, dare I say, credible regulation to a standard that they were used to. The days are gone of people migrating to wherever the lowest regulatory standards are. These days, people want to be well regulated. So the DIFC was created, as I say, it's a physical jurisdiction. The constitution of the country had to be changed to allow it to happen. And we're like a financial Vatican City, which is perhaps an unusual example. But so the laws of the UAE and the laws of Dubai don't apply in that 110 acres. We're jurisdictionally carved out. And so the laws that we wrote for the financial centre are what applies there. So we have our own regulatory laws, our own employment law, our own insolvency laws, contract laws. And if we run out of the laws that we've written for the financial centre, then it's the law of England and Wales that applies there. So that did give comfort for the world's institutions to come and base themselves in Dubai, in the DIFC, and now it's home to most of the world's large financial institutions. We've got the vast majority of the global SIFIs, systemically important financial institutions, are there, the banks, reinsurers, asset managers, fund managers, etc. And typically, they use it, the business model is that they use it as their regional headquarters for the Middle East, or it might be the Middle East and North Africa, the Middle East and South Asia, depending on each institution's business model, and doing serious and deep business. And then we've an equities exchange in the DIFC, and that's now the leading listing venue globally for ESG and green sukuk. So that's what it is and how we got to where we are. As to the opportunities that it presents means that there is great wealth in the region that now can be managed within the region. If you go back 20 years, a lot of the wealth that was in the Middle East was being managed out of Zurich or out of London or out of Singapore. Now the world's asset managers, wealth managers can operate and do operate in the DIFC, and much more of the wealth in the region is managed from there, and capital transformation takes place as well. As to the challenges, because we are a special economic zone and we're not a country, there are sometimes some boundary issues about what can be done within the DIFC as opposed to done in greater UAE or greater Dubai. So we must have good relationships with the central bank. The central bank has no jurisdiction in the DIFC, but we don't have any jurisdiction outside. So we have to have good cooperative arrangements with that. Then the other, and obviously very good cooperative arrangements with global regulators. There wouldn't be, probably not a day goes by that my staff wouldn't be in touch with the FCA and the PRA, because so many British institutions have branches or subsidiaries in the DIFC. Then the other thing that we need to be mindful of, though, is that on major national initiatives, while for regulation we're very focused on our own free zone, when it comes to national initiatives, we need to line up with a national agenda. So the UAE has net zero by 2050 agenda. It has a financial roadmap to get there in terms of transition and funding transition. So we sign up to that rather than trying to repeat it all for ourselves. But we can say more about the substance of that a bit later.
Okay, well, thank you. Sorry, I usually get a little thing in my lapel. Thank you very much for that. So we've heard a little bit about what's happening, how to talk about it, how to keep us on track in the area of, I'll say green finance, but take that as a surrogate for everything, ESG, climate, the future of the planet, and well-being. Each of you has worked in different countries. You think really internationally. Some of you have mentioned, you're all talking about international things just in these opening comments. So I want to start with a question about language, and it's about taxonomies. We're seeing a big drive to having international standards and taxonomies. A lot of these are in development right now and developing as well as the debate. Should these be local, regional? Are they more effective? Or should they be global so that they're commonly understood everywhere? Azalina, that's something I know you're actively involved in. Do you want to say something?
Yes, yes. Actually, that is something I'm very actively involved in, is the ASEAN taxonomy. So I think there is definitely value in having different approaches, although the targets are the same, because then it can tailor to the regional nuances or even national nuances. I think having a universal standard, while it might be something that would be a nirvana everyone wants, I think it's very, very difficult to get to. So let me just share a little bit around the ASEAN taxonomy. In ASEAN, it's 10 different countries. It is also not a country, it's a region. It doesn't even have the formal construct of the DIFC, so it's actually countries agreeing to work together as a region. So what we have, which is actually very useful, is that we actually have a multilateral governance where we have ministers and the economic ministers, the regulators, the central bankers, the exchanges actually meeting with at different times in the year, but with a consistent consistent agenda of what they want to do for ASEAN. So one of the things that have come together is actually something called an ASEAN Taxonomy Board. It's represented by all 10 member states, and it has regulators from all the different finance regulators. The central bankers are present, the securities regulators, as well as the insurance regulators. So this board actually is mandated to develop an ASEAN taxonomy to create a common language that will be used by all 10 member states as they look at the guidance towards defining what is a sustainable activity. So that's something that we have launched. We have actually two frames. One that is a little bit more foundational based, so it's qualitative in nature, because we have member states that are a little bit more at the beginning of the conversation. We also now have what is called a plus standard, which is a lot more metric based and a lot more aligned to the EU taxonomy. So I think the difference between what we have now, it's in consultation period. For those who are curious, it's actually available online. You can see it on the website, ASEAN Taxonomy. We are releasing the first sector, which is energy sector. And the slight difference between the EU taxonomy and the ASEAN taxonomy is ASEAN taxonomy uses a traffic light system where it creates a transition category called amber. So it's not just green or red, it's not binary, it's a lot more a traffic light. This is because I think we are trying to provide for more opportunities of companies to transition, to be able to share what their transition plans are like. So I think that's something that we have actually begun to introduce. It's in a consultation period right now. And the way the ASEAN have done it, and I think this is really useful, it agrees on certain principles. For example, being inclusive, making sure everybody is actually included in this process. It provides interoperability, which is very, very key. Interoperability and proportionality, which is timing. The speed of change of each jurisdiction is recognized so that there is a gold standard that you want to go to, but it leaves each jurisdiction to be able to actually move there in their own time.
Thank you. Thank you very much. Ian, I'm going to pop back to you, and then Michael, I'm going to throw the mantle on your shoulders after that. So again, we have emerging standards beyond taxonomies, obviously ISSB, TCFD, this month TCND. Regulators need to incorporate these international standards, because that is what they are, is international, into how they regulate within their particular local catchment, as it were. But regulators, financial regulators, have to regulate absolutely everything else about financial institutions. Take us through that. I mean, how do you balance that?
Yes, and if we could lock the doors about now, that would be a good idea, because what I'm about to begin with, I wouldn't want to be misquoted and someone miss out on what I say at the end of it. It does have to be borne in mind that we are financial regulators. We are not ESG or green regulators. Now, I don't pretend to speak for all the regulators in the world, but I sit on the board of IOSCO, which is the global standard setter for securities regulation, and we're involved in IAS and Basel Committee as well. It does need to be borne in mind that we have generally, as regulators, we have a set of statutory objectives that are given to us by Parliament, generally, or by governments. And you won't really find any message of green or ESG in our statutory objectives. Generally, our objectives talk about financial stability. They will talk about, for banks and insurers who are prudentially regulated, safety and soundness of those institutions. For capital markets, they will talk about market integrity and investors and consumers not being misled and having adequate disclosures made to them. And that's the task that we're given now. Fortunately, there's a very real part of what we're here talking about today that falls naturally within that. So, for example, banks, insurers, financial institutions generally face risks because of climate. So in the same way that I as a regulator would require, let's say, a bank to model, explain, articulate, be able to justify to us how they identify and mitigate the risks that they face in operational risk, they have to do the same about climate. The same goes for insurers and for reinsurers. When it comes to market integrity, then of course we need to make sure that firms that are listed and reporting entities and people who are offering investment products don't behave in a way that's false and misleading, that their disclosures are accurate, that they're not greenwashing. And so there's a natural part of this that comes into what we do every day as financial regulators. But unless, as happens in the EU, you get a directive, or unless there's a law that's passed specifically relating to ESG matters, regulators tend to treat them as just any other financial risk. And it's not our job to mandate a green economy. It's our job to give effect to or meet the objectives that were given, and it's our job to give effect to policy as it's given to us from parliaments and governments, etc. So there's that natural correlation, though, and all of us, in the same way that Malaysia has, we've issued our expectations to listed companies and issuers in terms of what they have to disclose, if they want to call something green or ESG, and there needs to be external verification. So most regulators have now issued those things, but we really try to coalesce around global standards. There are too many of them at the moment, so what we're more likely to do is look at what the Basel Committee is doing. We're likely to look at what the IIS and IOSCO are doing, and as I say, I'm on the board of IOSCO, and we just recently endorsed 2 of the ISSB standards, and so regulators will end up picking those up. So we need to look at the global bit. You think globally, but you act locally. And some of the standard development has taken a bit too long to develop, and so all of us are doing things in our own jurisdiction, but guided by the conversations that are taking place at an international level. But the rub is that if there was to be, say, a new version of the global financial crisis, or if there was to be a major banking failure, governments would be saying, where is the regulator? And depending on the persuasion of the government, they may or may not be persuaded by an argument where we said, well, we were actually over here working on our green bond guidance. Our core responsibility is still for the financial system as a whole, and this is another aspect of the financial system that we have to regulate.
Good, thank you very much. So now I think I'm going to put my banker's hat on for a minute, because I'm always interested in how do you actually do it? How do you get the money out? Where does the money come from, and what are you doing with it? I worked extensively as a banker in the US, developing completely new ways of financing the rebuilding and redeveloping of the most disadvantaged communities in the area where I worked. In this country, I have spent a lot of time both developing product and helping develop some organizations to support financial inclusion. In both cases, in both of those instances, what I wanted to do and wanted to do with colleagues was completely against the banking regulations. We could not do the things we wanted to do, full stop. So at the end of the day, we got some things done, and that was partly by walking with the regulator arm in arm and helping the regulator look a little bit more at the cutting edge, the leading edge. But these are always hard things to do. The other thing is, how do we, and as a banker, one of the things that always worked was if there was a bit of national money in anything, boy, did that take the risk off our shoulders, just a little bit. So, Michael, let me turn to you, and I just wonder if ESG itself is making life too complicated, if what we need to do is come away from a lot of that structure, not to stop it because we need it, but to start also a conversation that says, how do we finance and how do we make big pools of finance available for the things that we want to achieve in terms of green finance centers and even better clusters. So over to you.
Well, thank you very much, Susan. Satya asked a question about, the paradox of investments over 40 years, and there's a very straightforward answer to it: is investors don't trust governments. It's as clear as that. And Amanda spoke about government policy risk, and to Ian, you mentioned quite clearly, we're not here to regulate ESG and green. We're here to regulate markets. And I believe that we in ethics, if there's two principles, one is first do no evil, but I think the second one is clearly we are here with a moral obligation to make markets work for society. And I think we get dragged way too much down into telling companies how to run themselves. and not enough about how to make markets run effectively. And therefore, I mean, one of the things I'm proudest of, and my colleague, Dr. Parker's here today, is a concept we came up some 17, 18 years ago, which was termed policy performance bonds. And these were very much directed at making governments regulate themselves and to get skin in the game. I mean, you know, you're at all these conferences, but remember that something like 35 to 40% of liquid global finance is sovereign debt. That's the big market. We spend all our time on the 10,000 large corporates. The second thing I think we forget about is cost is everything. You know, consumers in 2011 in America drove 4% fewer miles. Is that because the Sierra Club was fantastic in its advertising that year? No, petrol prices went up 32%. Right? We saw a huge tick down in European emissions in 2016 and 17, and that's because the ETS price rose to be well above 85 euros. So what we were concerned about is, in the Corporation of London, we passed the first Clean Air Act in '53. We were fundamental to the creation of the carbon markets from '98 to 2005 when they were launched. So I'm really quite keen on making the carbon markets work. And what's missing in the carbon markets is confidence in governments. And so this past year, in March, I was extremely pleased that the government of Chile picked up on our thinking. They issued a sovereign sustainability-linked bond, and it's very hard stuff. The government of Chile has to reduce emissions from 112.3 megatons to 95 megatons by 2030, and it has to increase the share of renewables in the grid from 43% to 60% by that point as well. It's a 20-year bond, in a straight line to 2030. So if they fail to make those targets in 2030, they'll be paying an additional 2.5 percentage points for an additional 12 years. Very much like an inflation-linked bond. I have a policy, I fail to make it, I pay a higher interest rate. And when you think that we've got about 20-30% covered of global emissions in credible trading markets, if we could double that, which is easy because the existing system should go to 100%, that gets you to 46%. We can work politically on the USA, India, Brazil, Indonesia, Nigeria. But the biggest thing to me on all these things is they're bond cuffs. They're forcing governments to perform. Uruguay copied it. That brings us up to 3.5 billion. Just a tiny reminder, the entirety of the voluntary carbon markets last year, 2.1 billion. So this market, even with two issues, is much bigger than anything else. Chile's coming back into the market. Uruguay added deforestation to it, so we're moving into the wider ESG issues. So if I had to conclude, I'd say, I think we ought to be thinking about taking at least the C out of ESG. Governance is a crazy area, and it's nice to have a bit of oversight. I'm very, very sympathetic to all of the S goals, but when you look at the E, you've got three areas. Those that could be markets, forestry, fishery, globally. Those that, in my opinion, won't be markets, and we could have a debate about biodiversity, TEEB, I'm into set-asides and things like that. But the one area where we do have a global market that we just need to complete is carbon. And there's a real carbon solution if we ethically and morally want to say to society that ethics and finance fit together in markets that will make carbon reduced to zero by 2050. Thank you.
Michael, thank you very much. And I haven't done a word scan of all the regulation and taxonomies and standards that are out there. I don't know how often the word ethical pops up. It would be interesting to see, because that's at the base of all of this. So a final quick question just to go around the panel. You talked about talking to regulators in other countries, Ian. Should we accept as a premise that global problems require global solutions? And let me ask the question, what more could regulators do possibly to work together to address some of the issues of green finance, climate, and so forth?
Well, it does need to be tackled globally, but that is happening. So regulators are used to working to global standards. The good financial centers around the world, and Michael will have a view on those, but the regulators in the key financial centers, we sign up to the Basel Committee principles on banking supervision, we sign up to the IIS principles on insurance regulation, and IOSCO principles on securities regulation. So that's what we're used to doing. And then you have to translate those, though, to your home market. Because it's not necessarily the case that the level of detail that Basel might go into and is suitable for an advanced market might not be suited for some emerging markets. So there's always a bit of translation that takes place. But the good thing is that in this area, each of those global financial standard setting bodies are linked into the work that's been done on ESG. So Basel has now put climate risk into the Basel framework, for example. As I mentioned, IOSCO, we recently endorsed the ISSB, or two of the ISSB standards in terms of disclosure. So regulators will coalesce around good and sensible standards, and then you have to adapt them. So it's think global, act local. The final little thing I might say, if I can get it in very quickly, because of the great discussion on greenwashing before, again, as a regulator, I will be agnostic as to what form of misleading and deceptive conduct or what form of misreporting is taking place. And whether it's someone who's misleading investors in terms of fees, misleading investors in terms of returns or risks, or misleading investors in terms of the green credentials of something that claims to be green, I'll be agnostic about that. It's our job not to pick and choose causes. It's our job to take action in respect of integrity of markets. And if someone's giving misleading information, and it's in respect of a green product because it's not, or it's not being true to label, we would take enforcement action about that. But we would do the same if it's talking about if it's talking about fees or returns.
Thank you very much. Michael, you just said, of course, we need regulation, but we really need to get the money out and find the place. Of course, that's my view of the world as well. So I've just asked the question, what more could regulators do, perhaps to work together? Let me ask you, what less could regulators do to enable the markets?
I think that's an excellent point. Sonali was talking about smart regulation. To me, smart regulation is simple regulation, and simplicity, I think, is very much overlooked. So I believe Ian's right. Regulators have moved much better in terms of talking together and communicating, but go slow, go simple. And I'm afraid I'm not a big fan of regionalization or anything. Capital theory says that the flows of capital are most efficiently allocated when they're the least barriers. And a lot of these regulatory things create barriers, sometimes selfishly, sometimes unintended, but I would keep it simple. And when we finally get on to the fact, if you want any conclusion that this place is a mess, just look at the MIT Aggregate Confusion Project on ESG, just showing you the absurdities across the board of all the areas you might have liked to have Googled. Thank you.
Oh dear, I've got my homework for tonight. So I'm mindful of the clock and mindful of lunch, and if I ask another question, we'll be here through lunch. So let me just take a minute to wrap up. I started with this contrast between strong regulation or green finance. I finished by saying it doesn't really have to be either or, and you should really, as a financier, walk arm in arm with your regulator to walk at that cutting edge and to keep changing the environment so that these things work. I mean, the comment, Michael, that this is, or Ian, I can't remember now, regulating the markets. I mean, that's what we need to do. We need to keep in mind, and we need to always start outside and then come back in. And I hope at some point we stop this very human tendency to wag fingers at each other and each other's institutions and say, oh, you're not good enough. I think that serves a purpose for a little bit, but it doesn't really serve the ultimate purpose that we want. And I think what is most important is that financial services as a whole, including its regulators, have to move at pace, have to operate at the frontier to develop these ways to address the green economy. I think trust, openness, and a willingness to push the boundaries are essential to take us through this maze. And I think we've just been really lucky to have had 3 individuals with such characteristics on this panel. So please join me very much in thanking Ian, Azalina, and Michael for their time and wisdom.